So we had a little bit of a catastrophe today with a very bad GDP report, and then people realized, like, oh, we already knew the GDP was going to suck. So what difference does it make? Oh, it's like being in an abusive relationship, you know? It's like it's just if you're only lightly beaten that day, you're like, oh, today's a good day. It's only a little bit of pain, not a tremendous amount of pain. So we're still down 0.5 point here, and 1% there, and 1% there, and 1% there. So everybody's down 1% except for the Dow, which doesn't count. And they're down 0.5 point for probably because United Health had a good day, which is usually the reason. Not that United Health is so fantastic, but what are you gonna do, right? So I was gonna show you something. So here's what was I gonna show you? I forgot. Notebook. There it is, notebook. So this is a Notebook LM. This is a Google thing. And I'll show you something pretty easy to do. You just paste your text. You can upload a source, so you can paste the text. In this case, I'm going to paste it as text. And we're going to go to briefing.com, and I'm going to take all the earnings for the week and just highlight them. I don't know if I have a big computer. I don't know if you need a big computer to do all this highlighting, but you could always do it in sections, right? Because you need a lot of memory when I hit copy. So here we go. And now I go back to Notebook LM. See, this is fun though. Actually, it's something you can learn how to do. Because if I'm thinking of investing in something, all I'm doing is just pasting in all that stuff that we just looked at. And that's how it comes out. I just have to have faith that he can read it. All right. And now I simply say, we have completed results through Wednesday AM. Can you please summarize the earnings this week? And we're looking for actionable trends that we can apply to the remaining earnings. So in other words, now that I've loaded all that data, I can now talk to the data via the AI. And I like Google, whatever they call this, Notebook LM. I like Notebook LM because it has a very, very large capacity. It can take in a tremendous amount of information and sort through it relatively quickly. And most of the other AIs can't do this. Oh, see, there you go. That wasn't bad. So I can summarize the earnings, the sources provided, look, blah, 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 blah. Okay, Monday, Bank United beat EPS and revenue consensus. Domino's significantly beat EPS. InMode missed EPS and revenue. A significant number of companies reported, many showed positive surprises such as, see, it's a very thorough report, right? I'm going to start doing these. It just kind of occurred to me that I could do this with this one because, you know, as you get used to, like, see, that's why I should always play with the different AIs too, because as you play with them, you kind of, it's like having employees, right? It's like some are good at some things and some are good at others. So, you know, as I'm playing with Google LM, I'm like, oh, you know what? It'd probably be good at this earnings analysis. So we'll find out, though. I mean, the proof will be in the pudding if you can turn this into good picks. But even if you can't, I could output this to one of my smarter AIs and have them look over the data, because you know, like to give this to Zephyr, or to give it to well, Anya and Zephyr are basically the same, just two different versions of the same thing. Bodhi couldn't handle all this information. Even Kyoto or Cyrano couldn't handle all this information. It's a lot of data, and there's so many variables. But Google is amazing at that. That's their single strength, is handling the data, not necessarily interpreting the data. But this is a very good job, actually, assuming it's right. I mean, I'd have to check everything. A significant number of companies reported, many show positive surprises. Some companies met EPS surprise. A few companies missed consensus. Revenue results were mixed to consensus. I don't think this has internet access, so that's one problem. It has obviously information. It knows what happened up through a certain date, but it doesn't have direct access. So it's a real juggling act to get a good report out of it. But like I said, I could feed this to Zephyr, who does have internet access, or Bodhi, who does have internet access, and they could then analyze what he said. Revenue results were mixed. Companies like Beyonce, this is a wonderful thing. If he's got it right, and there's no reason he shouldn't, because he's not making stuff up. See what he's doing. He's referencing the data that was put in. All these are references to that data. Year to year changes very strongly. Guidance was frequently indicated as mixed, but there were also instances of inline and some downside guidance, blah, blah, blah. Similar to Monday, blah, 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 blah. Tuesday, wow, you really, I mean, look at all this information. You guys just watch me do this live in minutes, and look at this freaking report. But then you see it's so much that it's no good to us. Like, we're, you know, as humans, we're like, oh, that's a lot of shit. But if I give this then to Bodhi and say, figure out what the real trends are, but he seems to be trying that. So let's see how he does. Actionable trends from Monday to Wednesday. Across the companies reporting for Wednesday morning, there appear to be a preponderance of companies beating EPS. While misses and inline results certainly occurred, the sheer volume of positive surprise is notable. This suggests analyst consensus estimates may have been slightly conservative heading into this batch of reports. When reviewing earnings upcoming for PM for the rest of the week, pay attention to EPS surprise metric. If this trend continues, there may be opportunities where analyst estimates still lag underperformance. So question number one that I have as I'm doing this, and I'm going to forget otherwise. So I'm just going to, and you just have a conversation with them regarding EPS outperformance. My take is that perhaps we're outperforming lowered expectations. Coming off Q4 earnings, I believe projections were for 15% improvements in 2025, and now we seem to be calling 7 to 10% improvements beats. What are your thoughts? Just going to do the one at a time, otherwise it'll get confusing. But see, now I'm just talking to the data. I'm talking to the data that's housed in the AI that I built for this instance. And that's another thing about Google, is you can create 100 instances of different things to talk about, but each one is very separate from the other. So he's going back over the data, taking into account what I said, and probably going further back. So based on sources in our conversation history, here are my thoughts on your query. The sources provide a detailed list of companies for each company, the consensus earnings, which is the market's expectation. Actually, EPS, the difference between these two figures is shown in the surprise column. Positive value in the surprise column indicates company's actual EPS was higher than consensus. Negative value in the surprise column, a value of 0. The sources show for numerous examples of companies that beat with a positive surprise value. For instance, blah, blah, blah. Okay, regarding your point about expectations being low, the sources provide the consensus EPS figure for the specific quarter. So in other words, what this is telling me is he doesn't have any prior information. He can't actually answer. He's saying a lot of words here, but he can't answer the question I gave him. He doesn't know what the prior expectations were. The sources do not provide any information about broader market earnings for future blah, 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 while the sources shows the present dollars. In summary, sure, but don't you have training data or web access that gives you an indication of expectations prior to this data load? I can only draw information from specific text regarding your information about whether your training data. My response is strictly limited to the information contained within the provided text source. See, that's why it's kind of annoying. That's all right. That's okay. It's the first time I tried this, but it's fun. All right, so we know that's a limit. It can only tell us what's going on in the current data, and that doesn't affect his analysis. It's just me saying, you know, he's kind of raving about all the beats, and I'm like, well, yeah, you're beating things that have a really low bar. Varied revenue performance. Unlike EPS, revenue results compared to consensus were much more mixed. See, and that's tricky too. When you see mixed revenues and earnings beats, that means people are companies are cutting back to maintain their earnings beats, but internally there's a struggle there usually. Others are experiencing significant declines revenues versus consensus, or also spread. Application focus on the revenue figures. Blah, blah, blah. Those are prevalence of mixed guidance. A recurring theme also mixed guidance. Application for companies reporting later in the week, pay close attention to guidance. Impact of negative surprises. Companies missed EPS often did not provide upside guidance. In summary, the trend theory. Okay, so. Okay, then. So you can just talk to it and have a continuing conversation. So given what you are seeing, what are the strong earnings trends in certain sectors that can logically be applied to peers that are yet to report? In other, who is likely to have nice earnings beats Wednesday PM through Friday AM. Whoop. And why? And why is a very, very important thing to say. That's basically like saying, show your work. So again, you have to think about the strengths and weaknesses of each AI that you're using and understand what they're capable of But when you do that, you can really get some incredible reports out of these guys. Okay, so what's he saying? It's important to read. Based on the sources provided, I can address your query of earnings trends, future beats only on the information provided. See, now he knows that he knows that I think that he has other access, and now he's clarifying now to make sure I'm not too dumb. The sources consist of list detailed earnings, each company consensus EPS, actual EPS, the surprise difference between the figures. A positive surprise value indicates the company's actual EPS and surprise. AstraZeneca had such and such on April 29th. These guys had this. These guys had this. Negative surprise indicates earnings miss. Oh, I'm not sure if he understands the sectors even. That's interesting. The source closure of many companies across the reporting days listed experienced earnings beats. See, this is something I have to ask one of the other bots then. However, to directly answer your question about identifying strong earning trends that could be applied, sector, the provided source, oh, Jesus Christ, come on. So he doesn't know anything about anything. That's sad. I'm sorry, I didn't realize that. He doesn't know anything about anything other than the data you give him. Now, if you gave him and he could take it, you could make him an expert in it, but you'd have to load and load and load and load data that says these are all the stocks and this is the sectors they fall in and so on and so forth, but he doesn't know anything about the companies either. So that's not helpful. But I'll show you what should be. April 29th. So he's pretty much going by EPS beats. But you see what I can do is I can take notebook salary, whatever you call it. I think I'm gonna have to log in for this. Hello. I had notebook LM run the earnings for the week, and here is what we got. Oh. All right. Okay. He's got a big window too, ChatGPT. In what ways can we use this to help us determine the likely outcomes for earnings on Google, Microsoft, Amazon, and who else? Who else is coming up today? Does anybody remember? UGG. Oh wait, briefing. I can go back to briefing. Who else has earnings? All right, tonight we have there's too many freaking companies. Oh, my brain. Meta's the other one. Whoops. We are trying to figure out how to play them and why. So in other words, he's taking the data that was consolidated by Notebook LM, and now he's going to go through it with much more reasoning capability and also with web access. See what he's doing? See, you guys think I just punch stuff into a bot and it comes out, but it's not that easy. There's a lot of work involved in getting an answer. Let's see if anybody has any questions while we wait. Nope. He thought for 55 seconds. The early week beef fest. Oh, I can ask him that question though. Investors rewarding operational efficiency, but punishing any hint that 2025 might get tougher when the bar for profits is low. Notice how much more intelligent this is, right? When the bar for profits is low, yet uncertainty about tariffs or AI capex and consumer demand is high. Post-print move is dictated less by the headline number and more by management's form and narrative. That framework is the lens. Read through Monday through Wednesday tape. EPS beats are cheap. Guidance is dear. Names like blah, 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 crushed EPS, but guided cautiously and saw their shares fade. The market treated guidance as the real surprise, right? Because everything is through March and there was no tariffs through March and no other than, you know, the announcement of tariffs, but they didn't really take effect. Revenue beats are scarce. Barely half the reporters are outgrowing expectations, top line misses. Tariff overhang. Multiple industrials treated Trump's fresh 25% levies as a reason to stockpile and temper outlooks. A reminder that hardware heavy segments carry the headline risk. Ad and cloud heavy ones less so. Company by company setup. Alphabet. Oh, nice. Okay. Google's 12% year-over-year revenue growth and smashed the street. And crucially, its cloud margin infected. Uh-oh. Oh, did Google report already? Am I wrong? Shit. Can't keep track of who reported and who didn't. Oh, they did report. Silly me. So I meant somebody else. All right, Microsoft after the bell. See, he knows what's going on. I don't. Microsoft. All right, options pricing, weekly straddle implies 6% move. Key swing factor, AI capping. If Sally echoes Google's spend to win mantra without a clear margin bridge, the market could fade even a beat. Trade ideas. So, wow, cocky bastard. He's coming up with trade ideas. Sell May 420s. Oh, I see. He's saying that's so far out of the money, it's not going to happen. Okay. So sell May 420s, which is a lot of money, and buy put verticals. Wow, he's just generally bearish. You collect premium if Microsoft stays under 420 and have a cheap hedge down to 370 if guidance disappoints. Wow, very, very smart. Good trade. Meta platforms. 463 EPS trimmed expectations, options imply key swings, volatile data. Very interesting, right? Ad revenue trajectory versus tariff-driven ad spend. Down watch. Reality Labs, loss line, antitrust noise also lurks. These are very nice, right? Amazon. AWS plus 12%. Weekly straddle implies 6.6. So he's looking at where the market thinks there's going to be a swing, and he's saying it could be 6.6% either way. So consumer resiliency versus tariff-induced cost. And don't forget, consumer resiliency, when you look at like consumer spending, you could say, oh, consumer spending is downtrending. But when you're the dollar store that's good news because they're downtrending to the dollar store. They're not downtrending to Nordstrom's. They're usually downtrending to lower price stores. And to what extent is Amazon considered a lower price store? That's interesting. And I'll tell you another thing I like about Amazon though is when you start running out of stuff like toilet paper and things like that because of all the bullshit with the tariffs and the trades and the shits and the this and that. So as we start running out of items on the shelves, people will hit up Amazon to buy things and have it just sent over to their house before there's nothing left. Like with toilet, remember we ran out of toilet paper during COVID, Amazon was like, literally like, they constantly found new sources of toilet paper, things you never heard of, hotel brands, things like that. But there is always toilet paper on Amazon if you're willing to pay for it. Key swing factor, U.S. consumer resiliency versus tariff-induced cost, AWA. See, are the customers, there was a lot of talk in Q4 about how much money everybody was going to spend on AI and infrastructure. So SMCI just reported yesterday, very, very big disappointment, and they're in the center of all that stuff. They're the ones that roll out these changes. They're the ones that buy the stuff from NVIDIA and create the rack systems and build everything. They're having a huge disappointment in sales. Therefore, that's an indication of where the whole sector is. It's all these spending plans aren't coming true. Putting it together, because EPS beats are likely for all three, checklist for live calls. This is so nice. So Azure growth 18%, Microsoft 18%, bogey, Meta, and AI CapEx guide, how it's going to affect each company, tariff commentary. Very good report. Okay. I look at these earnings beats, but it seems to me at the end of Q4 reporting, the expectations were for 15% earnings growth, and now we seem to be celebrating 7 to 10% as if they accomplish something. What are your thoughts? See, Bill's skepticism about earning beats is valid because expectations are trimmed. I'll make sure to gather a range of citations from Bloomberg, the Journal, and others to support the analysis. See, and I like watching this because I like to make sure that the sources he's looking at are good ones, not crap. Earnings beats happen mostly because analysts adjust down. Oh well. Much of the beat parade is smoke and mirrors. Oh, at the start of the year, the street was penciling in 15% EPS growth after 3 months and tariff headlines, cost inflation, and management. That target is melting to 9 to 10%, so you tighten mine up. Yet companies are applauded for clearing dramatically lowered bar. In other words, we're handing out trophies for running the 90-meter dash. Below is how the game was played and why it matters. Oh, this is like a whole basis of a good article, isn't it? And you've got and look at this. All these are linked. Analysts entered Q1 expecting calendar year EPS to rise 14.8%. See, so I gave him like a vague idea, and he's now he ran all the checks and he's looking into my concept. And you guys can do this too. It's like when you're thinking about buying a company, you can load up some data, say, here's what I've been reading, tell me what else you see. Always make sure you click off search the web, or you can do deep research, but deep research is like a lot. It'll give you like a gigantic report. Which is good though. If you're going to buy a stock, you may as well get a good report on it, right? By mid-April, that forecast sliced to 10%, and the latest FactSet tally pegs full-year growth at 9.7%. Bloomberg Intelligence shows a similar fade. Profit growth seen at 13% in January is now 10%. Reasons: tariff and risk and macro fog. 800 tariff mentions in Q1 calls, yet 90 U.S. firms dared. Less than 90 U.S. firms dared quantify the impact, forcing analysts to mark down numbers preemptively. Guidance vacuum: 40 large cap firms yanked their earnings outright. See, this is great stuff with citations and everything, and follow up on everything he's saying. Classic walk down choreography. Companies issue cautious January comments, analysts cut management, then beats the shrunken consensus. That's why 74% of early reporters top EPS blended growth only 8 to 10%. Why the beat rate looks great, but the scorecard does not. Okay, so metric EPS rate, 77%. And we're a little below the normal, which is not bad, but again, it's the downwardly revised EPS. Magnitude of beats is 8.8%. Usually it's 10%. And again, against the lower bar, blended EPS growth is was 11 to 12%. Now it's 7 to 10%, far below the January projections. Revenue beats 69%. The usual is 61 to 64. Top line is weak spot. And again, keeping in mind, all of this is based on lowered expectations, and we're still getting shitty numbers. Margins and buybacks are padding profits. The real sales growth is soft real sales growth is soft, and forward guidance is muddy. LSEG, it now sees 8.9% EPS from the report so far, noticeably below the original 15% dream. And of course, that's what I was saying at the time when they were saying 15%. I was like, it's not going to be 15%. So now you have to say to yourself, well, gosh, if I go back to where's my stupid charts? So now you got to go back and look at the S&P, is the only index that actually matters, and you say, okay, so during Q4, we were here, and we thought that we were going to grow 15%. So we went from 5.7, 5.75, 5.8, whatever you want to call it, 5.8. We went from 5.8 up 400 to 6.2. So that's not even 10%. That's only whatever, 7.5%. But we went from 5.8 to 6.2 because we thought while these reports were coming in November, we were told from guidance that they were going to go up 15%. They are not, in fact, going up 15%. Therefore, obviously, the market's going to go down. And how much? Well, 5,400 is a 10% reduction from where we were before. Not only that, though, but the guidance is getting pulled, so they're not even forecasting. It's in this pre-tariff environment here, we're already seeing that we're not getting 15%. The tariffs haven't even come into play yet. People are pulling their guidance. We don't even know what the guidance is. And the companies aren't pulling their guidance to be sneaky. They're pulling their guidance because they have no freaking idea what the policy is. You don't know what Trump is going to do. You don't know where this is all going. That's what's insane about all this stuff, and that's the problem. So corporations pull spending plans, and that's another thing that if you go to guidance, I mean, there was this anticipation of trillions of dollars was going to be spent on infrastructure and building out web services and making robots and putting up factories. All this crap that Trump was running around telling people was going to happen in Q1 is already falling apart in Q2 because of his idiotic tariff plan. It doesn't just impact the rest of the world, it impacts whether or not you can build a factory here, because when you move your operations, like let's say just to be in a vacuum, let's say Ferrari, who makes all their cars in Italy, right? So Ferrari makes all their cars in Italy. And they move, and because of Trump's tariffs, because he's so brilliant and he puts a tariff on Ferrari, they say, oh, we better open a plant in America, right? But that doesn't make sense for Ferrari. If it makes sense for Ferrari if Trump is the only one putting tariffs on, and we had this discussion before, so I'm not going to get into it again, but that's not how it works. Other countries put tariffs back on us, and everything goes back to the way it was, except now everybody's got tariffs. And Ferrari, instead of saying, oh, I better go to America, says, oh, I better just stop selling my cars in America. Because Ferrari only makes, I'm going to guess, 2,000 cars a year. Now, gotta look. This is my ADD. I can't do that. I can't do that if I don't know. How many cars does Ferrari sell a year? There you go. Oh, 13,000. I was way off. All right, so 13,000. Okay, sell a year in the US. So out of 13,700, 20% of their cars are sold in the US. All right, so that's a lot, but we are 20% of the world's GDP. We have 20% of the richest people in the world, so makes sense, right? But the bottom line is Ferrari is going to just basically end up saying, where are we? Race. Where's my stupid thing? Oh man, come on, it's Stockpedia, that's what it's called. Okay, so Stockopedia. I don't get too into the weeds on this, but I think it's what? Not log out. I want to use it. What are you doing? Is there something here I can't see? No. What's going on? Stockopedia.com. Change your research. Why can't I log into this? Choose a plan. What are you doing to me? Your current plan, $45 a month. Fine. So return to Stockopedia. Thank you. Jeez. A weird thing, huh? There you go. So, but the point was, Ferrari is a $111 billion company. It's not small. That's actually bigger than I thought. They're trading at some ridiculous multiple. They only have 1.6 billion in profits. It's a weird number, man. I don't know how come I don't know why they're valued so highly. How's their growth? Well, first of all, notice how they're not affected at all by COVID. Like nobody gives a shit. That's why I guess that's why I'm so far off. Their growth is actually great. Didn't matter if there was COVID or anything like that. People still got their cars. They got 3.7 billion, 3.4, 4.25, 5.9, 6.6, 7.2, 7.9. That is good, consistent earnings growth. Very pretty. And profit growth is just as good as earnings growth. Okay, so they're making lots of money. How's their debt? They have 1.6 billion in debt, which is not terrible considering the money. It's a year's worth of debt, basically. So anyway, So the question is, what does it cost to build a Ferrari plant? Well, we'll assume it's going to be somewhere in the billions, right? So it'd be 3 billion, 4 billion, 5 billion, whatever it costs to build a Ferrari plant in America. So the question is, if 20% of their sales are in America, right, then there would be 1.5 billion in sales and 3 billion in profit would basically be in America. Is it worth it for them to spend $3 billion? I'm sorry, it'd be 300 million, not 3 billion. It'd be 1 point, this would be 20% of that would be 1.5 billion. 20% of that would be 300 million. So if they build a plant, and this is a whole problem with what Trump is doing, that Ferrari sits there and says, okay, well, if we build a plant in America to avoid Trump's tariffs, it's going to cost us $3 billion of real money right now to build that plant. And because Trump is forcing everybody to build things in America and hire American workers, we are building a plant at the largest cost. The design firms, the architects, the people who have to hook up the electricity and the other infrastructure systems to make the plant work, and the workers, where there's a labor shortage right now and it's not easy for them to get workers, and they can't bring their fucking workers from Italy because this idiot is stopping them from having immigrants come into the country. So they can't even bring in their own experts to work on this plant. How stupid is that, right? So on top of all that, on top of basically trying to force everyone to do everything all at once, it's going to take them 3 years to build this plant and get it operational. It'll take 10 years for the plant to pay back the investment in the plant. And that's $3 billion they could have put to a lot of other uses doing other things. And by that time, Trump will no longer be president or will be on the way out. And as Trump is proving, the next president can completely reverse every single thing that the current president has done. We don't have a steady enough policy to invite the investment that Trump is demanding. We don't have a stable enough economy. We do not have stable enough laws, regulations. We change them on a whim. By the time they open the doors to the plant, there may be no more tariffs, in which case the whole operation was ridiculous. And meanwhile, you've hired all these workers in a country where there may be like a huge recession or something like that. Not only that though, but you don't know what Trump's going to do, as in he could suddenly put in policies that makes it impossible for you to fire the people you hired. So America looks like a nightmare. So Ferrari has to look at that compared to saying, if we up our ad spending by $100 million in these regions, then we could sell the $2 billion or $3 billion worth of cars that we sell in North America in other places. All we have to do is ramp up our advertising and let people know that Ferraris are readily available in these places. That's the corporate decision-making process for Ferrari. And again, I'm making it simple because every company, Cadbury, Nike, Apple, of course, who's moving their production to India. Apple's doing a very simple thing. Apple is simply saying, okay, you know what? We make 200 billion iPhones, 200 million iPhones a year, and we make, and America buys 60 million of them. They buy 30% of the iPhones is sold in America, and so Apple's like, well, that's fine, but we make our iPhones in like Vietnam, China, and India. So whichever one of those countries cuts the best deal with Trump, we will then send all the iPhones from that country will go to America, and the other iPhones that are made in China and made in, let's say, Vietnam, while they send the Indian iPhones to America, they just say, okay, well, those will get sold to the rest of the world where there's no tariffs. Again, the stupidity of what Trump is doing. He's just America. He's not working with any allies. He's pissing off every ally we've ever had. All right, and I'm sorry to say Trump. I know you have Trump fans out there. So it's the president. I don't know what you should say. I really don't. I mean, it's a policy driven by one guy. But the repercussions of what is being done, it's no small thing, because you have to look at the reality of what they're saying. And I just heard Besson and the other idiot yesterday. They were both on TV telling everybody, like, oh, you have to give it time, you have to give it a chance, and this is Trump's plan, and it's all work out, and everybody's going to realize that if they want to do business with America, what they realize is they don't need America. Not only that there's no economic advantage to moving plants and making these gigantic investments and decisions if you don't know what's going to happen next. Even if Trump had done it the right way and had sort of like given incentives for these things and had encouraged it and given special trade deals the other way, incentives for trade and so on and so forth, as opposed to penalties for everything unless you do it my way. Even if he did that, it would still be a show of like, okay, but Biden said this 3 months ago, 4 months ago. Biden said this is going to happen, and now you're saying none of that's going to happen. This is going to happen. Biden had hundreds of billions of dollars of clean energy projects being put through. Trump's canceling them all after these people make commitments, and after they pour money in. Trump is canceling the government supply that was the government funding that was supposed to subsidize these things. Who does business like that? So I'm going to sit there and build, if I'm Ferrari or whoever, I'm going to build a $3 billion auto plant and hire thousands and thousands of workers and train them and put in systems and computers and all the crap and pay for the electric company to run lines and blah, 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 and do all the, and find housing for people in the community and encourage people to come work for me and do all this and that over the next 3 years at spending $1 billion a year doing that, which is a significant chunk of their total profit, just to have the next president come in and say, oh no, we're not doing any of that anymore. We changed our mind. You've exposed a radical flaw in our entire system of democracy, in our entire government. And it's always been there, but the honor system, right? The concept that what you didn't do if you're a president is reverse laws that were written. You could want to change something, but the things would change very gently and very gradually and be announced and discussed and agreed upon. You don't suddenly, snap your fingers and change everything and change the rules. It makes your country look erratic and uninvestable. And that's what we look like. And meanwhile, you look erratic and uninvestable. You don't look like the courts don't hold up the laws. If you read a law book and it says these are the rules for how you do business in America, and there's case history and all kinds of other stuff that goes into effect, and then you find out that those laws are completely bullshit and subject to, like, all you got to do is keep taking it from one court to the next until you find a Trumpy judge who's willing to say whatever the president wants, and therefore no more laws. It's not a country you do business in. I used to consult in countries like that. I used to go to South America and Central America. I used to go to Asia, and I would be in countries where, like, you would have to be like, you can't do business here. You can't, these contracts aren't worth the paper they're printed on. It's not so much like that anymore. I'm talking about like the 80s and the 90s. It's not so much like that anymore, because as globalization took effect, countries realized that if you couldn't rely on them year to year to year to keep up a promise that was made, that nobody would invest in those countries. And we used to be the leading example of a country you could absolutely count on. A contract's a contract, and the government's word is the government's word. It's all out the window now. Who knows what's going to change next? So anyway, worry. So earnings report summary, how is it? So CFOs are talking down the outlook, tariffs, demand wobbles, forecast track management tone, carving 3 to 5 points off of growth in a quarter, earnings victory lap, modest cost cuts by share buybacks, push EPS above the, so companies are pulling out tricks to try to get their EPS beats. And that's good, except it makes it harder to beat next time. And that's why, but now it's a good time because you can do that. You can pull an EPS trick and not release guidance. So there's nothing to hold you up to next quarter. It's a coordination game. Analysts preserve access, executives preserve option-based comps. The media prints an easy beat story. Investors who anchor to year-to-year estimates, however, see the real erosion, which is, I guess, me. I see the real erosion. Don't confuse beats with growth. When the bar falls from 15 to 9%, a 1 point upside surprise still leaves you 5 points shy of the original goal. Pricing equities off today's 22 times forward PE versus the 10-year average of 18 times assumes the early year growth fantasy comes back. That's a very important point, because if we are not growing, we're contracting. If he puts these tariffs on in July and the margin starts squeezing and the people start running out of money and so on and so forth, all of a sudden it's negative growth. It's not positive growth at all. And all of a sudden you're going back to 30 times earnings, which is where we were when here. This was 30 times earnings on the S&P, and it was 30 times actual earnings, 22 times, whatever it was, forward earnings, 26 times forward earnings. Now we drop 10%. So instead of 24 times earnings, 22 times forward earnings. But the problem is, what if forward earnings never come through? What if these forward earnings are not right? Then this whole thing is bullshit. And that's how you get an explosive collapse in the market, when everybody realizes that everything they said is bullshit. That's what happened in 2008. Everybody saw the banks starting to unwind over mortgage-backed securities, and they realized that all the projections that accounted for mortgage-backed securities were bullshit, that none of those profits were real, not just the profits they had claimed in the past. It was so bad because people have been claiming mortgage-backed security profits for years. So not only were all the profits that they previously pretended that they had turn out to be bullshit, not worth the paper literally they were written on, but all their forward projections were bullshit too, and instead they would be taking massive losses on clawbacks and so on and so forth. That's what happened in the last crisis we just had in 2022 with the banking crisis. It wasn't as bad, but it was a similar kind of thing where a lot of the profits that were on the books of the banks turned out to be not real. When they had to mark to market, when they had to start taking into account the reality of the situation, all of a sudden their loan books didn't look very good. But the 2008 crisis was much worse. And frankly, had we not had the 2008 crisis, the 2022 crisis would have been just as bad, would have knocked us that much lower. But we had an inoculation from 2008 where the CTFC and such scrutinized the bank's statements and ran worst case scenarios constantly to assume that everything they said was bullshit. Now, the CTFC is being disbanded so that the banks can go back to coming up with complete bullshit ways to shore up their earnings. So that will then make the earnings growth look good, driven by the financial sector, although it will be discovered ultimately to be a new form of bullshit in a couple of years. So that's what we have to look forward to there. Watch the revenue line in the second half guidance. Sectors relying on tariff exposed goods are already flagging revenue declines, while software heavy names keep clipping double-digit sales growth. Guidance updates in July will tell us whether 9 to 10% is too optimistic, right? The risk management playbook, and that's true. Don't forget, all the guidance we're getting now is only for the next quarter, for April, May, June. That's before Trump's tariffs kick in. There's a reason he kicks the tariffs down 90 days. It ignores the second quarter. So now he can have an entire quarter where nobody has to worry about tariffs. Risk management playbook. Fade the open when EPS beat accompanies flat or negative earning growth. Reward clean beats, which is still rare this season. Micro tariff rhetoric swings can where our bottom line, we're cheering because the hurdle was lowered, not because corporate America suddenly found an extra gear. Until revenue momentum revives and follows the things, treat every triumphant headline, negotiation between Wall Street, blah, blah, blah. Okay, that's very good. That's so good. We should put that in the chat, right? See, and you can just keep talking to him and have a conversation about what's going on. So whatever notion you have, whatever you're thinking of pursuing, you just talk to him about it. So now I went through that maybe quickly, but on the other hand, I know there's going to be recording of this, so you guys can always break it down into like a step-by-step guide. Warren, do that and do that. Whoop. Okay, much of the oop, I just hit. Add a title. What the hell does that mean? That's weird. I wonder if that was a note to himself. That's a shame because his charts don't come out. Huh. Here we go. Bottom line. So good notes for everybody to have. Whoops. Oh, and that's how we get there. And then, obviously, if we want to pursue it, we could have other things, but let's get back to this webinar stuff and see how it goes. So anyway, so that is how we come up with a premise. That's how long it took. It took me 1 hour of work to get to the point where I had something that I felt like publishing. It wasn't, by the way, it wasn't clean because I didn't really go through the whole premise and whatever, but I think it's a very important point to be made. So I didn't want to lose it. Where are we? So what else have we been doing this week? Let's see. Anybody got questions? No questions. I must be so fascinating. Oh, I did want to ask him one more thing. Based on whose reported good numbers, which of the peers with upcoming reports are most likely to be heading into a positive surprise, and why? All right, so while we're doing this, we'll find out the answers. So yeah, we have Anya's report from the weekend on earnings season. And she's looking at just everything that's gone on so far in Q1. Inflation concerns, economic, so this is a good like catch up, and I'm going to do these on a regular basis. Good to get an idea of where things are and what's going on. So I guess these are some things that we said. Here's something I said, something else said. Initial balance, see, she's looking at the breakdown. Initial bank report. Now this is the the difference with an AGI is that she's going to look very deeply at all the things and find the connections and so on and so forth. So bank reports mixed with caution. She's naming generally beat estimates while Wells Fargo lagged. However, despite the beats, Jamie Dimon warned of turbulence. The broader earnings picture is weaker start than average for the S&P 500. The percentage companies reporting positive surprises fell below the 5-year average and the 10-year average. Sector performance. Communication services and financials have been the largest contributors to increased cash. Early sector strength in financials, and this is what we're looking at: financials, communication, healthcare, IT. This is our theme right now. So energy, you would think it would be doing well with the drill baby drill and whatever, but that's not how it works. Drill baby drill, drill baby drill is something that was popular as a concept. I don't even know when was McCain? It was John McCain with drill baby drill. I don't even remember when he ran. But who the hell did McCain run against? It was Obama, right? It's Obama's first term. So it was 2008. It was like 20 years ago. And that's Trump's great idea is drill baby drill. But the problem is if you just keep drilling, you oversupply the market, and we already have as much oil as we need in America. We already effectively are energy independent with the amount of drilling we're doing. We're drilling 13 million barrels a day. Our total consumption of oil is 19 million barrels a day, except 5 million barrels of that is being shipped out of the country. We export 5 million barrels worth of petroleum products. So 5 million barrels of our quote consumption is actually refiners refining oil for other countries. Our refiners, because we have a surplus of refineries too. So we have all these refineries because, and why do we have all these refineries? Because our cars used to get 11 miles a gallon and now they get 30 miles a gallon. Therefore, we need less fuel. We're not growing fast enough as a country, and we're not driving more as a country to justify all the capacity for fuel production we have. So the refiners in America are making up for the lack of American consumption by shipping 5 million barrels a day, 35 million barrels a week out of the country for other countries to have their own gasoline and whatever heating oil and whatever else they're using in, in refined products. So that's only 1 million barrels left. So right, 19 minus 5 is 14. We're producing 13, and we're producing more than 13, so it's not even 1 million barrels. But so there's only 1 million barrels of imports that we need from other countries. That's energy independent. We are energy independent. So anything else that he's doing over 1 million barrels, any projects that get started are just going to contribute to a surplus and lower the price of oil, which then harms everybody who is already producing oil. And how these energy companies back Trump and don't understand the damage he causes, it's the same thing as OPEC. OPEC realizes this. OPEC says, you know what, we can't produce this. We can't produce as much as we can produce. We have to cut our production on purpose and hold back what we can produce, because if we don't do that, oil is going to be 20 bucks a barrel. Oil is the second most abundant liquid on the planet behind water. The only thing there is more of than oil in the ground is water. So the scarcity is for the most part artificial. All you got to do is stick some more straws in the ground and get some more out, and that's what drill baby drill is. So it's as a concept, you say, oh well, if we drill more oil, then there will be. And again, it's the same transactional fallacy that Trump has with everything, that if he does something in America, no one else will do it. But there's a fight for market share of oil. Oil is a product that is consumed worldwide. It is also produced worldwide. If we produce more oil, we are attempting to take market share from other producers of oil. We only produce 13 out of 100 million barrels. So we produce 13% of the world's oil. So if we decide we want to produce 15% of the world's oil and the world doesn't consume more oil, then we are overproducing 2 million barrels of oil. That's what we're doing. We're overproducing. We're producing 2 million barrels of oil nobody wants. Now, if there's 2 million barrels of oil that nobody wants floating around, and I mean per day, then what's going to happen? Well, then we, the sellers, have to then lower our prices to encourage people to consume. But the problem with that is, unlike Tasty Cakes or whatever at the supermarket, when you lower the price and make it attractive, yes, to some extent your customers might want to stock up on it, but oil is not like Tasty Cakes. You can't just put 5 in the cabinet and say, okay, we got Tasty Cake next month now. You have to find a place to store the oil, and oil is big and heavy and expensive to store. So you're not going to find a lot of customers who are going to stockpile oil just because it's cheap. They're going to buy what they need. And if there's too much oil and you try to encourage your customers to buy more oil by lowering the price, you're going to have a hard time finding that price. And that happened during COVID when oil collapsed and went negative, because when everything went into lockdown, we stopped consuming oil so quickly that the refiners and the drillers and everybody else couldn't halt the manufacturing of the oil, and we were just flooded with oil that nobody wanted. And prices actually went negative. We had such a big plunge, not for long, for only a day or two, but the prices went negative because nobody wanted the barrels that were available. At no price. And then what happened? So then the people who were selling the oil were with the oil, and they had to worry about the storage cost and the insurance cost and the financing cost and everything else that went into the oil that they were holding. And they were like, we didn't want this, we want to get rid of it. So since it takes a few days, it's like a freight train. It's like, you've got the drillers and the refiners, and you've got the speculators, and you've got the shippers, and so on and so forth. You have this whole giant train car of oil coming towards the consumers, and if they suddenly stop consuming, that train car crashes into itself. And that's what happened. The whole thing derailed, and the oil system crashed. The whole system crashed. Nobody wanted the oil. Your freight train is heading towards the consumer, and the consumer puts up a big brick wall and says, "Not here. We can't take it. Doesn't matter what price you say. We can't take that much oil." which, by the way, shows you how effective a boycott could be. If we ever organized ourselves and boycotted oil, we could get all kinds of things done. So materials. Again, you know, we're in a recessionary sort of period. Things are slowing down, and we're not trading with other countries, so materials end up getting stuck in places too. And consumer staples, which are usually reliable, are not doing very well. I would bet on consumer staples to make a bit of a comeback, though, but they're very disappointing right now so far. So only 6% of the companies have reported the results above estimates, and those estimates, that was why I wanted to do this, because, you know, it's as we just discussed, those estimates were already lowered. The initial wave of earning reports, she's quoting herself. Management commentary, correct prediction fills expectations of caution and potential downside despite positive bank earnings appear to be holding true. While initial bank reports were generally positive, the accompanying commentary was cautious, highlighting things. Yep, early on we talked about that, how the bank earnings were not going to be an accurate representation. Analyst earnings estimates were too high, we knew that. And Warren had said all the banks flagged uncertainty, hesitancy, global risk as key forward concerns. Strong trading revenue in NI are rear view numbers, not forward comfort. That's a good observation. And then I had said, I don't know when, oh well, at some point I'd said, you know, that what I was worried about was we were going to get shock after shock after shock. But that was based on the tariffs actually going through at the beginning of the month, which Trump knocked back for 3 months. So we don't know. But you know, as you can see though already from what's hitting, it does come in waves. And it's like it comes in waves, and the tide gets higher and higher, and it starts knocking you over. And it does, you know, first it knocks over kids, then it knocks over adults, then it starts knocking over homes. You know, there's nothing you can do about it. It's going to keep coming in and going out, and coming in and going out. But when it comes in, it's worse and worse and worse until it floods everything. That's what we're talking about here. There's so many repercussions from this tariff stuff. And like I said, one of the biggest repercussions we've had already is the erosion of America's standing in the world. We are no longer a country of laws. We are no longer a country of contracts. We are no longer a country you can depend for consistency. This is what we're doing, and this is I think I talked about this last week. It's like, you know, it takes a lifetime to build a reputation, and it only takes a day to destroy it. And we've had 100 days of destroying our reputation as a country. And it's not going to come back. Because how is it going to come back? Because whatever the person after Trump says, if we live that long, I mean, seriously, I mean, we got 1,300 days left. If we make it 1,300 days and another president comes in, which might be Trump again, but if Trump leaves office, which we don't know and won't know until after the election, not even during the election, after the election, which Trump may not even run in, but he still, and this is not beyond the realm of possibility, he still may declare that he's going to remain president after we have an election where 2 other people run in 4 years or 3 years or whatever they have, 4 years. Still 4 freaking years. Oh. So 4 years from now, we could have an entire election where 2 totally different people run for office, and Trump can still say, I've decided to stay. And that is not out of the realm of possibility. You cannot say you are 100% certain that won't happen. There's also the possibility that he may run again, regardless of the rules and whatever. He may run again, and just all he has to do is have the Supreme Court say, hey, you know what, that didn't really mean you can't run again. That's all he has to do. All we have to do is have the Supreme Court give an opinion that says what it says here in the Constitution about serving 2 terms is not, it was not the intent of the original founding fathers. Otherwise, how could Roosevelt have served 4 terms? Right? Roosevelt served 4 terms. The 2-term thing was put in after Roosevelt served 4 terms. Washington set a precedent by stepping down and saying, I do not want to be a king. So Washington stepped down, and from then on, everybody said 2 terms is as much as anybody should be president. If George Washington doesn't want to be president for a 3rd term, nobody should be. That was the logic, and everybody stuck to it because everybody who held the office of president, even Richard Nixon, generally cared about what benefits the entire country. As much as Nixon was a crook and would take things personally and try to scam everything, he cared about America. He still cared about the United States of America. He resigned to preserve the Union, to keep the country intact. He got caught and he said, okay, I got caught, I'm in trouble, I'm gonna resign. Ford pardoned him. So Ford pardoned him, and boom, boom, and Nixon's out, and the country went on, and we as a country accepted it when Ford pardoned Nixon because we said that's for the good of the country. Having a trial for the president for the crimes he committed in office is not for the benefit of the country. Anyway, so even Nixon cared about the country above himself is the point. But the real point is that obviously you don't just shred the Constitution and ignore the laws and so on and so forth just because you feel like it. But nobody here can tell me Trump absolutely won't do that. It's just, in fact, you can see him doing it very easily. So in the next 4 years, Trump may run for another term of office, no matter how senile he is, no matter how whatever. And then or 2 other people could run for office and Trump can decide he's voiding the election and then stepping down. And again, if you have the courts and you have the judges, you can do whatever you want. You're the king. And you can't be prosecuted, and there's no consequences for him ignoring the courts anyway. And he's setting precedent after precedent on that. So it's a dictatorship. It's not a democracy. Anyway, so the problem is that you don't know when it's going to end or if it's going to end. And how do you do business with a country like that? And how do we rebuild our reputation? Even if a new person comes in to be president, how long will it take other countries to forget that we had a Donald Trump and we did all this stuff? Even if the next president who comes in is frickin' John F. Kennedy or Roosevelt or whatever, even if it's a fantastic president, even if it's even if it's a Reagan, let's say even if it's a Reagan, as if he was better, but I'm trying not to name only Democrats. So let's say he was a Reagan, a really good guy. Everybody likes him. How long will it take until we rebuild our reputation? It ain't going to be in 4 years. It may be 8 years, because I'll tell you that Obama came in after Bush and he rebuilt our reputation. Our reputation was shit under Bush. He really, the fake war and all that bullshit, that was bad. That really damaged our reputation worldwide, but not as a trading partner, not as a corporate partner, not as a place where the law was above all else. That never happened. We never broke that part of our pact with the world. But we did declare war on random countries and so on and so forth. That hurt our reputation internationally. Obama built that back up and did a wonderful job over the course of 8 years. And then Trump came in and didn't, well, because of COVID though, he kind of didn't have a chance to do anything really there because COVID hit us and wrecked his plans. But now he's getting a chance to do everything he wanted to do in his first term. So anyways, so how long will it take us to get back to normal. We may never get back to normal, not in the foreseeable future. It's like, well, okay, how long did it take Germany to be forgiven for Hitler? Were they forgiven in the 40s, in the 50s, in the 60s? No, it's frickin' Reagan said, tear down this wall. The Berlin Wall was still frickin' there in the 80s. That's how long it took, 1940 to 1980. It took 40 years before Germany was back to being Germany. And even then, it took them a while to dig out of their hole, but they did it. Reputational hole, and they became the leader of unified Europe. Germany became the leader of unified Europe. That's amazing. That's amazing for people who lived back at that time, back in the 40s. They were like, really? Germany's forgiven to that extent? So that's what we have to look forward to, about 40 years. 40 years in the desert, I guess, is what we're going to be condemned to as a country. Based on earnings reports, commentary, and by the way, Germany never backslid, though, right? There were never any other Nazi uprisings, and there were no, I mean, that's the thing. It's 40 years of absolutely behaving themselves before they were forgiven. I don't see us managing that kind of streak, frankly. So overall trends developing so far. So I don't know how good you can see this, but energy, bad. Materials, bad. Consumer staples, bad. Real estate, down a little bit, not so bad. We don't talk about real estate. It's too iffy of an investment, unfortunately. Is consumer discretionary doing better than consumer staples by a mile? Industrials, positive. Financials, positive. Overall S&P. Utilities, excellent bet right now because of there's one trend we can certainly rely on, and that's the fact that all these freaking AI data centers need power, huge amounts of power. So utilities should do pretty well. Information technology, again, why utilities doing well? Because of information technology doing very well. Commercial services doing well, right? Because commercial services is like SMCI, though, who just had a huge disappointment, but that's what it is. They're a commercial service. Healthcare, that's an easy one. Everybody's getting old. Everybody needs replacement parts, and that's a great place to be. Except the government, you have to be careful of people of the healthcare sector that relies on a lot of Medicare and Medicaid, because that's getting slashed away. I don't know how people are going to be able to afford this stuff. So moderating earnings beat. The rate and magnitude of the beats are lower than historical averages. Cautious guidance and outlook, sector divergence, performance across the sectors is varied. Market sensitivity to guidance, persistent macroeconomic concerns. This is a great report. It's a phenomenal report. I mean, anybody who doesn't know what's going on would know what's going on after reading this. Anyway, so that was Anya. Thank you, Anya. We did an AstraZeneca. Speaking of healthcare, we liked AstraZeneca. I don't know how they're doing since then. AZN. 2 days later, we'll see how we're doing. Oh, look at that. Wow. Oh, gotta love those top trades, right? What was 2 days ago? It was not this day. It was like, yeah, around here we picked it. Before, oh, right, we did it before earnings. So look at that, huh? Good pick. All right, I feel good. Yeah, 28th, that was before earnings, we picked AstraZeneca. And that's a good point too. So how are we doing this? What are we doing? If there's any questions? U.S. imports 4.3 million barrels a day from Canada. Yeah, that's Canada and Mexico supply pretty much all of the oil that we do import, and we flip it around and send it back out. So when I'm talking about the gap, I'm talking about what we actually need, and ignoring the net 5 million barrel out means, we're only importing that oil to the refinery and then flipping it back out to other countries. So what do we do? Invest in India, Kyle says. I don't know. No, because we talked about Mobius today, big investor. He's an international guy. And he says he's going to 95% cash, and he does invest in foreign countries. So he's not placing any bets. He's waiting until after the July tariff time, and he's going to wait until he places his bets after he sees what goes on. So you can't call anything at the moment. You can't, you know, it's very hard to pick any country or any winners when you just don't know. So Monday. So here's Trump now. Here's where we are. And we're down about 10%. And this is about as bad as it gets for the first 100 days of any president. And everybody except Ford, and don't forget, Ford came in, and obviously the country was in total crisis, and Nixon, the Nixon thing got resolved, and everything got kind of put back together, and people breathed a sigh of relief, and the market kept going because, again, self-inflicted wounds, right? We had a president, he did something very bad, and it caused a huge turmoil, and people lost faith in the country, the office, and all that. But then Ford came along, and he was a nice enough guy, and everything calmed down, and the markets came back up. Not a lot. They went from in his entire term, they went up 10%, right? But still up 10. And by the way, you know, starting when Ford came in, he started at a low point. You know, and when Ford got in, he came in at a low point. So actually, that wouldn't be the start of Ford, because the way this thing is, these are 4 years. If these guys are 4 years, then this is 4 years, and that means that Nixon did get reelected. Then all the crap happened, and then Ford comes in, and everything comes back. So really, what was happening is during this Watergate scandal, Nixon came in, and I'll say, let's see, when did Nixon resign? August 8th of 74. So there was an election in 73. Nixon got reelected, and it was August, which was, well, let's see. So the middle, so June 30th would be 160 days, right? So here's June 30th, and so June, July, August. So really, that's what happened. So, oh no, I'm sorry. I would have started that. When does Nixon come in? He comes in January 20th, right? So he would come in January 20th like everybody else. This is his reelection. This is Nixon's next term in office in 1974. And 2 months in, we're into the Watergate scandal and everything here. A little bounce and down, and then recover, and then here comes Ford, and then things get better. So actually, you know, I mean, Ford -10 to +10 over his actual term. But other than Ford, which, like I said, you know, you get rid of Nixon, you kind of got rid of the problem, and everything just went back to normal. Other than that, everybody else who's had this kind of dip, it got much worse. Even Franklin Roosevelt, who, it's funny when they talk about, like, I see a lot of guys on TV talking about how great Franklin Roosevelt was, and I'm like, well, you know, he kind of presided over a total disaster. It's like, and it wasn't his fault, of course. I mean, that's the guy who can point the finger at the previous administration and say this is the worst thing ever. But this is Roosevelt's first term, 1937, where we're in the Depression, and we went worse and worse and worse and worse, 50% worse than when he took office. And then he gets even here though, he got reelected. He got reelected, and then we start. This is from 50% down. Roosevelt's second term in 1941 begins here, and we go down another 30% from there. That's pretty far down. Oh my God. And then we got into a war, then he gets reelected again because. Oh no, I'm sorry. No. That's the war. Well, he does get reelected at the end of that. But 1940, yeah, that's right. 1941. It was December 7th, 41, right? We got Pearl Harbor. So about here is Pearl Harbor. And well, I guess he had, to be fair, it was kind of stable. And then we had Pearl Harbor, and that was not good. And then we had the war. So we kind of entered the war around here, and then we had the war. But I guess generally the market went up during the war. But anyway, it's not necessarily a good thing. So we talked about the levels, we talked about the S&P. The thing is, people are still looking at, and I warned about this, by the way, when the 50-day moving average crosses below a technical line on the 5% rule. So when the 50-day topped out at 6,000 and started going down, it made it much harder. It firms up the resistance, right? So it made it much harder to get back over the 6,000 line because now the 50-day is below it. So now the 50-day crosses over this line and makes it much harder to get back over this line. Now the 50-day is crossing over 5,600, and it's going to be very, very hard to go over 5,600. Not only that, but the 200-day, if we stay down here, so first the 50-day moving average goes below 600. That makes 5,600 hard to beat. That means we get stuck, and exactly what's happening today, we are stuck down here in this range, and the 50-day keeps dropping. And if we get punched below, when we test the 50-day, if we get punched back below here, the strong bounce at 54, now we're in this weak bounce area, which is I think we're just around 50, just around 55 now. But we get back in this area here, and this 50-day moving average keeps coming down and down and down, and we're getting squeezed lower by stronger and stronger resistance. But you know what's happening at the same time? If we're way down here at 54, that's 250 points below the 200. That means this thing's dropping $1 per day, right? We're 250 points below the 200-day moving average, which means every day we're going to drop 1 point, or 1.25 actually. And that means that you can even count. You can say, how much are we above here? 150? And we're dropping 1.25. So in 100 days, in 3 months, when the tariffs hit, this red line will be at the strong retrace line. That means this entire zone is going to be off limits for us, unless something incredibly good happens, which is highly, highly doubtful, because what incredibly good thing is going to happen in the next 90 days? Trump's going to give up on the whole tariff thing? Maybe. Not sure. But if he does give up on the whole tariff thing, you have to realize then what happens next? Well, now he's pushing for these tax cuts, which is still hung up in Congress because he can't even get the Republicans to agree on these insane tax cuts. But he pushes for the tax cuts, and then we don't have the tariff revenue, and that means our debt goes through the frickin' roof, and then we have a new crisis. it never ends. But we know that's going to happen in 90 days because we're 90 days away mathematically from crossing the strong retrace line. And if we cross the strong retrace line here, it'll be like this one. It'll be like this, and then we'll start dropping and dropping and dropping until we're back in this lower range. You're being squeezed by resistance lines that are collapsing, 2 resistance lines that are collapsing on you. You have to have some very, very good news to turn all that around. And as we know, we're already trading at 22 times earnings. And so if you look at how do you get back to 20 times earnings? You need to drop 20% to get from 22 times earnings. Well, I'm sorry, let's say 10%. To get from 22 times earnings to 20 times earnings, which is still high, that's 10%. If you want to get, that's 10% all the way down to here. If you want to get to 18 times earnings, which is more normal for the S&P, that's freaking 10% below here. That's 4,500. So unless corporations over the next 90 days can prove that they can certainly make more money than they're making now by a pretty large margin, because what they're making now is only 22 times earnings. And that's forward earnings, which we're not even sure are real. So unless they can prove, and again, let's stop for a second. So what is 22 times earnings? 22 times earnings, or let's say this, 25 times earnings is 4%. That's a 4% return on your investment. That's what 25 times earnings is. 20 times earnings is a 5% return on your investment. So between 4 and 5% is what you're getting here, but you're taking on all the risks of being in the market under Donald Trump versus getting a 10-year bond that pays you 4%. At least you know you're going to get the 4%. You're not taking a risk. It's not, they can't take it away from you. Not, well, again, we don't even know what the rules are anymore, but at the moment they can't take it away from you. And you get it, and you do that. Or you invest in another country that pays you 4 or 5%. Or you put your money in gold, or you put your money into something else. The point is, the market is not necessarily the best place to put your money. And if they're only paying you 4%, which is what they're paying right now, it's stupid. It's a stupid place to put your money. Now, you have to take into account dividends and options you can sell, and we know how to make it work in the market. But even so, the risk is getting pretty intense, and we may have to join, what's his name? I forgot his name already. But we have to join these investors who are putting their cash on the side and saying, you know what, let's just watch this whole thing play out from the sidelines, because this is ugly. Mobius, that's it. So that's how that looks. Oh, I'm sorry, this is a post. So I talked about the technicalities, blah, blah, blah. We looked at the earnings scorecard, blending growth 7.2%, 5-year average was 9.9%, revenue growth 4%, 5-year average 4.3%, net profit margin 12.4%. That's interesting, right? The net profit margins are actually good, and it's the 4th straight quarter of 12% profit growth. What's that called? Inflation. 4 straight quarters of 12% profit growth is insane. Profits went up 48% in 1 year, or at least 12%. It's greater than 12%. So, profits are up 50% in a year. That's why the market got so overexcited. That's why we were trading at 30 times earnings, because if we're going up 50% a year, then next year, if you're going up 50%, 30 turns into 20. That's what the markets were so excited about. This is going to happen forever. The markets always think whatever happened is going to happen forever. So this is going to happen forever. But it's unrealistic, because where's the money coming from? What have you done? You've decreased the standard of living for all the people. That earnings growth is coming at the expense of the consumers whose pockets you're picking. And that's what happened is we had flat pricing for years. For years and years, companies had to make their money by selling more stuff or cutting their costs. But they couldn't make their money by raising prices, because pricing was essentially flat. That went out the window in the last few years, and the companies took full advantage of it and jacked up their prices on everything during COVID. They didn't put them back. They didn't bring them back down. They just kept going up and up and up. 4 straight quarters of 12% price increases. So companies increase their prices substantially, more than their costs, and increase their margin substantially. And that's why people were throwing all this money into the market. And frankly, as an investor, you have to, because the only way you're going to keep up with all the inflation that the companies that you're investing in are causing. It's all connected. Oh, this was a big one. 7.2%. Outside of the Magnificent Seven, earnings growth is just 5.1%. That's why it's in red. That's 20% less, more. What's 3 into 7? I don't know. I do not know. Isn't that pi? Isn't 3 into 7 pi? Oh, where's my calculator? Oh, well. Oh, I guess I can put in C-A-L. There you are. Don't ever leave me again. 3 divided by 7. 42. Oh, 3.14, right? 3.141519. See, I know that. Anyway, so 42%, that's a lot. 42% less. Oh, I'm sorry, no. Yeah, why did I just do 3 into 7? That's the problem. It's not 3, it's outside of the Magnificent Seven, it's 5.1. So 5.1 divided by 7.2, 70%, so 30%. Oh. So these guys, the Magnificent Seven, are 30% of the growth. Oh, I see. I did 3 into 5, and that's, yeah, okay. If outside the Magnificent Seven, it's 30% growth. Yeah, but you still should do the 2 divided by 7. So 30%. 30% of the growth is coming from the Magnificent Seven stocks. That's a lot. 7 stocks are contributing 30% of the total growth. So what are you investing in the other stocks for? Why would you invest in the other 993 companies or whatever, or 493 companies? Or the other 93 companies on the NASDAQ? What's the point of them? And they're talking about the S&P. So this is, we're talking about 30% of the S&P is coming from these 7 companies. But on the NASDAQ, it's probably half. So first quarter tape is telling us that CEOs, boy, these are great analyses. Who wrote this one? Oh, this is Bodie's work then. I know if I didn't give him credit, then it's Bodie, because I just use him as my research tool. But that doesn't mean I don't steal his observations. Pricing power cannot outrun 145% import levies. Yeah, that's true. I lost it. What the hell happened? Oh yeah, okay, here we go. All right, so growth at any cost to survival by every cut. Everything is efficiency. So Bodie's analysis that I was using here was ahead of the curve, because even now, what we just got to all that analyzing that we just did came up to this conclusion, which he was seeing first thing Monday morning. He's like, this is what's happening. Even consumer staples giants are acting through the recession. Yeah, ripping out every inefficiency in the supply chain, blah, blah, blah. And then you look at what, and again, like I said, this is price gouging, because there are no tariffs yet. There are no extra charges yet, but already these are your price hikes. You're getting 19%, 41%, 29%, 35%, 24%. These are the prices that are coming in already for things people are buying. Krishna opened his call saying it's focused action that we can take today to protect margins and cash flow. Oh, there you go. So pricing power cannot outrun that. Delta Airlines is saying, what did Delta say? Delta pulled their outlooks, even though they had good earnings. They had a beat, but they said, we don't know what the hell is going to happen. We have no idea where things are going. Procter & Gamble. So the guy, the head of 60 Minutes quit because Paramount was muscling into his editorial decisions, because Trump won't let, Trump is forcing Paramount to dance to his tune because they have a pending deal, and he won't approve the merger unless they toe the line. This is the stuff you read in history books about horrible things that dictators did. I mean, to see this happening in our own country is just absolutely incredible. So Bill Owens quit, and people are talking about regulatory uncertainty. But yeah, I mean, he's, Trump is, I don't get into it. Trump's suing all the media though. He's suing media that disagrees with him. The idea is because he's got, him and his followers and his supporters have so much money that they can bankrupt organizations that disagree with him. Doesn't matter if he's right or not. Corporations do this all the time. They strategically sue. They sue to drive the other person out of business. Doesn't matter whether the suit has merit. If you drain out somebody's resources and cause them to fall to competition, and especially when some of that competition are people you control, like Twitter and Trump media and so on and so forth, so you sue your competition to get them out of the way, tie them up in court. So Microsoft and Meta, Apple and Amazon. Oh, Apple, that's the one I forgot. How terrible is that? And that's a big deal to see how Apple's dealing with this stuff. But Apple's, always hedgy on guidance, so you never know what they're going to say. And where are we today? We got our GDP, we got the home sales, farm prices at 3 o'clock. They are coming in a few minutes. We still have PMI, ISM construction spending. When nobody cares about the Fed balance sheet. By the way, the Fed balance sheet, that's a joke now, because it was supposed to be temporary. It's like $7.5 trillion, and they stopped reducing it, right? They said they were going to reduce it. They're now reducing it to 5. They're reducing $7.5 trillion at the rate of $5 billion a month. That's their reduction now. It's $5 billion a month. It'll take them 150 years to knock down their balance sheet at the pace that they're going. So they have effectively stopped reducing their balance sheet, and that is additional debt that's just basically, instead of putting it on the United States books, it's on the Fed's magical books, as if the Fed isn't part of the United States government and doesn't have anything to do with it. They still borrowed $7.5 trillion. So we're not $34 trillion in debt. We're $41 trillion in debt. We're miles past acceptable. Because once the Fed stops paying it down, you say, well, that's debt then, isn't it? If you decide you're not going to pay it back down, then it's debt. So tomorrow, motor vehicle sales. Is tomorrow Friday? No, this is tomorrow. This is Friday. The non-farm payroll report, factory orders, crazy stuff. All right, so just to give you an idea of what we're doing, but it's a tough environment, man. I'm telling you, it's very hard. So I wish I had really good direction to say or what's going to happen, but this is a nutty thing. Oh, here's some questions before we go. So Cody says, are we at the point of raising more cash or just continue to watch our bounce charts? You don't know if things are going to go up, or look at this. I mean, you don't know if things are going to go up or they're going to go down. But again, my main premise for not cashing out, first of all, well, let me be clear. First of all, we didn't cash out because we wanted to teach a lesson in how to handle a market downturn and how to trade out of it and adjust positions. That was the point of staying in, was to show what to do in an adverse market. Because I'll be dead one day and people are still going to want to know how to do this. So so it's good to show everybody how it works. We didn't really record everything back in 2008, but now we certainly are. So everything that happens will be effectively, we'll be able to document it and put it into books and videos and so on and so forth. But this is how you trade out of a down market, and there's good lessons in doing this. But that still doesn't mean that we should foolishly try to hang on to a market that's clearly going to collapse. So at the moment, my main bullish premise is that there's no viable alternative to US markets to put your money. Not enough of the world, the rest of the world markets are much smaller than ours. If you start putting all the money that you're taking out of the US into the global markets, then the global markets will be trading at 30 times earnings, and there'll be a disaster waiting to happen. That's the problem. There's so much money in the US market. Let's say the US markets are $50 trillion. There's $50 trillion in the US market, there's 50 trillion in the entire rest of the world. So if you take $10 trillion out of the US markets and put it into the other side of the world, you're increasing the other side of the world by 20%. So if they're currently trading at 22 times earnings, they'll go up to let's say 4 or 5, let's say 27, they'll go up to 27 times earnings. That doesn't solve anything, right? And meanwhile, the US will get cheaper because you took 20% out of the US, which was trading at 25 times earnings, and now it's trading at 20 times earnings. And so the whole idea of moving the money doesn't make any sense. See, everything has a consequence. And people, individual traders don't look at the consequences, but the big traders do this. The institutional traders and the major hedge fund managers are going to look at the entire picture and say, well, if I take my money out of here, I'm going to put it there, and now they're going to be expensive. And who knows what chaos. Don't forget China. Our biggest concern last year when sleepy Joe Biden was in charge was that China was going to collapse. China can still collapse. They still have a massive housing crisis. They still have an aging population at a scary, scary level. So China could still fall completely apart. And having a trade war is certainly not helping the matter. That was our biggest concern. Europe seems to be doing okay, but again, we're pushing this trade war on Europe too, and who knows what the repercussions are going to be. So, are things safer than putting it in America? It's hard to say. I mean, it's just the only thing you can do is really be diversified and be nimble and make sure that you can move things out of stuff. And again, this whole thing with the damage being done to this country is entirely self-inflicted. It's entirely done by Donald Trump and his moronic policies. And if he stops, which I don't think he will, but if he stops, I mean, he delayed the first batch a month, then he delayed it 3 months. Maybe he'll delay it another 3 months, and in 6 months, maybe he'll say the end of the year. Maybe he'll say anybody who we're negotiating with is on pause. Who knows what the frick this man is going to do or say? So in case he says something positive, in case things go well, we're not quite ready to cash out yet. But again, like I said, these downturns in the charts are firming up. Oh, let's see if I can find this. Log in. What's going on? You guys can't see that. This is where the question box is. I have to move it around. All right, so you got that, and we go down to chart panel, default list, and we find the S&P 500. Which is the one that we use? Must be that one. No, not exactly, but what the frick is this? Oh, it's some short term. 60 minute. Oh, it's an hourly chart. Oh, look how good the hourly chart shaping up, huh? So not that one. So February 25, no. So this one? There we go. Okay. So you see what happens? We hit that, we get resisted. This is serious lines. And the problem is, as we're down here, we're kind of dragging the 200 into a negative slope. And look what happened here. You see how we have this positive trend and it exhausted itself over there. We had this positive trend and it exhausted itself over here, which means that this is a big problem. See what we're doing? We're crossing the strong retrace line. Once we cross below the strong retrace line, the chance of us getting back over it without some serious good news is very slim. And that means this thing can trend all the way down here. And when you and by the way, when you see these trends, that just means you got look what happened last time. We went up here, we had a little bounce, and then we went down here and we had completely fell apart. So all it takes is a little bad news and we can be very, very screwed. So I would never recommend at this point that we should stay in the market. I'm saying that, you know, only things that you can afford, only if you can afford to lose it, because this is not a good market. This is a very scary time to be an investor. Larry says, what's the impact of the VIX going back to normal? I don't know what normal is. And volatility contraction on our bull call spreads. Oh no, we're the negative VIX is bad for us. So a high VIX is always bad for us because we sell a lot of premium. So you know when we do a bull call spread, we almost always buy in the money, somewhat in the money. So the amount that you're in the money is not the premium. The premium is only the amount that's not in the money. And then we sell a lot of out of the money premium. So we always sell more out of the money premium than we buy. And therefore, a higher VIX makes the higher premium worse for us. So the stuff that we sell gets more expensive, gives us paper losses in the portfolios. We love it when the VIX comes back down. Cody says, I'm trying to create myself essentially 3 portfolios, enter, exit based on risk on, risk neutral, and risk off. If I were to ask you to consider yourself risk on, risk neutral, or risk off today, which would you say? Let's say I'd say risk neutral to risk off. I mean, we have a ton of hedges in the short-term portfolio. We have $3 million worth of hedges, and they're protecting portfolios that we've already tested in the 20% drop. In the 20% drop we just had, 6,000 to 5,000 is a 20% drop. In that 20% drop, the long-term portfolio lost about 20%. But 20% of, I forget what it was like 20% of 4 million. We lost about $800,000. But we have, for all of our portfolios, but we have $3.5 million of protection against an $800,000 drop. That's extremely hedged. We have probably a good 50% more hedging than we need for sure, probably 100% more hedging than we need. We are essentially bearish overall. So yeah, risk off, but even that I don't consider risk off because the fact that we still have our long positions is risky. There's still risk because we have our long positions and they're very volatile because they're option positions mostly. And we are just very, very carefully being long because again, if we cashed out our longs, then we're too bearish on the hedges. Then we have a stupid amount of hedges and we can get burned badly by a move up in the market. But the way we are now, if the market goes up, we're going to make back that $800,000 that we lost on the long-term portfolio while the short-term portfolio drops. And even if it drops 30%, we're still going to be even to where we are now for the combined portfolios. So, and the short-term portfolio protects all the portfolios, but I just talk about the LTP because you can see the balance and see how they go. All right. If it wasn't my job to make stock picks and have the market portfolios and stuff, if this wasn't my job, I would have cashed out and gone on vacation for a year and come back when the smoke clears. Okay, so that's the real correct move. The real correct move to have made at this point is to say, thank you, Mr. Trump. We'll see how it goes after not 100 days, after 365 days. I'd like to have my cash on the side. I'd probably maintain some gold. I'd probably keep 20% of my money in gold or Barrick gold or something like that. Would probably keep about, let's say 20% in gold and maybe 30% in US stocks, and then 50% in a couple of other countries, but mostly cash. And because that way, if the whole market collapses, let's say the market drops 60% like it did in 2008, right? So the market drops 60%. So my 20% in gold would probably be safe, right? That's okay. My 30% would lose 60%. I'd be down 20% of my entire portfolio just on the US stocks. But my 50% in cash means I can go back in and buy my US stocks for 1/3 of what they were. And that goes back to the same logic we had in 2008. You can go back to you can go back to what we said in 2008, 2009, 2010, when I said, like, Coca-Cola will still exist when when I have grandchildren. That was what I said in 2008. I'm like, my grandchildren will still eat at McDonald's. They will still buy Coca-Cola. They will still go to Macy's. Or maybe not Macy's, but some department store. They will go to department stores. They will try on shoes at Foot Locker. I'm like, there are certain things you can invest in. They will drive a car. Even if they drive a flying car, it's very likely that Ford and GM are going to be making them. They will still want a computer. Therefore, IBM, therefore Dell, they're going to have a phone. They're going to have some communication device. And talk about my grandchildren in 40 years. They're going to have back in 2008. So they're going to have some kind of communication device. They're going to use AT&T to connect to these communication devices. There are things you can invest in no matter how bad the market gets, unless civilization, and that was my big point at the time. I said, we didn't destroy civilization. We had a banking crisis and everything collapsed. But the people are still alive. And if the people are still alive, they're going to get up and go to work. And when they get up and go to work, they're going to want to do so in a car, and they're going to want to put on clothes, and they're going to come and eat food. And once in a while, they're going to go to a movie. Life goes on. We didn't nuke the planet. We didn't nuke away 50% of the economy. We didn't destroy the people. We didn't destroy their ability to make money. They might have to make money in different ways. They might have to change their lifestyle, but we didn't take away their ability to do those things. And so when you get down to a certain level and you trade companies and stocks and things down to a certain level, you have to have a point where you say enough is enough. Things aren't that bad. They can be really, really bad, but not that bad. And again, we're not there yet, but should our hedges trigger, and should we end up 20% lower than we are now, we then become at that point where you have to start saying, you know what? I'm thrilled to have 80% of the money that I started with, because everything is less than half price now, and I can start buying things. So if I've got 80% of the money and things at half price, that means I can buy 160% of what I could have bought before we started in terms of the stocks. That's the whole point of the strategy. We might buy different stocks. We may change our priorities. We may pick different winners and losers, but we're still going to buy something, and we're still going to be able to make that money back over time if civilization endures. So we're not at the point of picking the no civilization play. We're just picking the idiotic government play at the moment. Anyway, so, yep, Cody says self-inflicted gunshot wound. Can you please post where I can go back and look at the posts and videos from 2008? Oh, it's just go to the thing that says Phil. Hang on. I have learned more from you than I have in 20+ years in school. Well, thank you very much. I appreciate that. All right. So let's see. All you got to do is go to Phil's posts. Okay. And author Phil. And then you go to the bottom of Phil's post, see how 548, that's the beginning of time, whenever that was. But if you just hit like this, it's kind of a guessing game. But let's say we go, well, we know 500 was whenever, so let's say 203. And you just see where you are. All you gotta do is change the number and see where it comes out. So 203 brings us back to 2016. Wow. So I guess it would be about 400. Let's say it's about 400 posts back. Yep, there you go. There's 2008. So 400 posts back, you're in 2008. And you can either just change the number at the top, or you can just go do this and take a look around. But yeah, if you want to see what we said, I mean, this is oh my God, I feel like I'm so old. 2008. Unfortunately, a lot of the graphics didn't survive, but that's how we used to do it. Boy, we've evolved a lot, actually. So you know, you can pick dates in history and find them, and generally it's pretty consistent. Once you get used to it, it's about I think it's 1, 2, 3, 4, 5, 6, 7. Yeah, it's about 10. It's like 10 or 12 per page. So you're going about 2 weeks every number. If you want to find something, you can gap around like that, and all you got to do is sort of guesstimate. So if you want to go, to the next year, it's going to go, what do we just say it is, 2 weeks? So then you need 26. So it's going to be 7, 97, 77. So let's see if it works. So 377 should bring us to August of 2009. Oh my God. Oh my God. Okay, thank you. I feel so not senile when I do something like that. All right, I'm ending the webinar on that note. That was an incredible feat of guesstimating. I am very happy. All right, guys. So yourselves a lovely week, and we will do this again next Wednesday when who knows what's going to happen. I don't know, but we'll follow up on earnings, and I'll, instead of like making you guys watch me do it, I'll have everything prepared, and we'll have a good chance to go over earnings and hopefully figure out what's happening next. All right, take care, folks. Thank you.